Hi everyone, welcome to the webinar. My name is Chris Ashton. I am the head mentor at the Corellian Academy. Today's presentation is focused on providing market insights about the US presidential election, which is just over a week away on November the 5th. As a trader with over 20 years of experience, I can tell you this is a unique event, as this election can significantly influence market sentiment and increase volatility in some of the instruments that you may trade, not only for the next week in the run-up to election day, but for days, weeks, and even months afterwards. Let's run through the structure of what's coming up. First, I'm going to highlight the basics you should know about this US presidential election and what's at stake. Then I'll discuss why the election should matter to traders, including setting out some of the key market drivers for the election. Next, I'll move on to run through the historical impact of the previous two elections in 2016 and 2020 to give you an insight into how US stocks and the dollar have responded during those events. Then I'll move on to outlining some things for you to consider if you are planning on trading the event, paying particular attention to your risk management during any election trading. I'll then finish by discussing the tools that can be utilized to aid you when trading around the election. If you do have any questions, please put them on the chat or the Q&A section of the Zoom webinar, and either I'll answer them at the end of the presentation, or for any specific questions regarding the Plus500 platform, a member of the customer service team will contact you with an answer after the webinar. Okay, let's move on. So what is the US presidential election and what's at stake? Let's do a quick run through. The US presidential election takes place on November the 5th, as I've just said. It's between Kamala Harris, the Democrat candidate, and Donald Trump, the Republican candidate. The winner needs 270 electoral college votes to become president. So what does this mean? Rather than a direct popular vote, like in the UK, for example, the US election is decided by electoral votes, which are allocated to each state. In this system, US citizens are technically casting ballots for a slate of electors who have pledged to cast their electoral college votes for either Kamala Harris or Donald Trump. The number of electoral college votes for each state is roughly in line with the size of its population. So, for example, California has 54 electoral college votes, while a much less populous state like Alaska has just 3. Now, generally, states use a winner-takes-all system, awarding all their electoral college votes to whichever candidate wins the most votes from US citizens in their state. This is interesting for traders, as it means whether a presidential candidate wins 50.1% or 90% of the vote in any particular state, they are still awarded all the state's electoral college votes. So importantly for traders, a candidate can become president by winning several tight races in certain key states, despite potentially having less votes than the other candidate across the US as a whole. This is where you'll hear the term swing states mentioned. While most states consistently vote for the same party, swing states change their allegiance election to election. The key swing states you need to listen out for are Georgia, Arizona, Pennsylvania, Wisconsin, Nevada, North Carolina, and Michigan. Also at stake on November the 5th is control of Congress. These are the lawmakers who set policy in Washington and will either support the new president's agenda, clearing the way for the new policies to quickly become law, or make things very difficult for the new president by either forcing amendments, watering down proposed laws, or blocking them altogether. Congress is made up of the Senate and the House of Representatives. Right now, the Democrats control the Senate with a slim 51 to 49 majority. However, on November the 5th, 33 of the 100 Senate seats are up for re-election. 23 of these are currently held by Democrats, and just 10 are being held by Republicans. So things could get interesting here as well. Currently, the Republicans control the House of Representatives by a narrow majority of 221 seats to 212, with just 2 vacancies. However, on November the 5th, all 435 seats are up for re-election, making this another key political battleground. Okay, so that's the basics for election night. Let's move on to look at why this 2024 US presidential election matters to traders. So why will it matter? In short, because it can significantly influence the economic and financial landscape, impacting market conditions, policies, and investor sentiment. Here are 5 key areas for you to consider when trading the election. The first is policy shifts. Different administrations often have distinct approaches to taxation, regulation, and fiscal policies. A more business-friendly administration might lower taxes, reduce regulations, which could be good news for future company earnings, boosting stock indices. Conversely, a more progressive administration might increase regulations or raise taxes, potentially impacting corporate profits and investment strategies, which could be a negative for stock indices. Currently, Kamala Harris has indicated her desire to raise the top rate corporate tax from 21% to 28%, a potential negative for future company earnings of the big US corporations, while Donald Trump wants to reduce corporation tax from 21% to as low as 15%, which could be seen as a positive. In terms of regulation, Kamala Harris wants to double the minimum wage, expand student debt relief, and expand corporate regulation and enforcement in key areas, while Donald Trump wants to cut regulation and reduce barriers and approvals for mergers and acquisitions to help them go through quicker. So you can see that there are 2 key differences there as well, which could impact stock markets. The next is monetary policy and the Federal Reserve. Although the Federal Reserve, the Fed for short, the US central bank operates independently, the president appoints its leadership. This is important for traders as the direction of monetary policy, including interest rates, can be influenced by who holds office, which has a direct impact on the direction of the dollar and stock market performance. Currently, Kamala Harris wants to preserve the Fed's independence and is expected to keep Jerome Powell as the current chairman, as the new chairman, ensuring continuity and a smooth transition, which could be seen as a positive for risk sentiment as it reduces uncertainty. While Donald Trump could challenge the Fed's independence and replace Chairman Powell with someone more in line with his policies, a potential short-term negative for risk sentiment, although in the longer term, Trump is seen as favouring easy money policies and low interest rates from the Fed, which is often welcomed by markets as good news for future US company earnings, but could risk stoking inflation, which the Fed has just spent 2 years trying to get back under control. So you can see why this could be a volatile period to trade. Number 3 is trade policies. The US president plays a central role in shaping trade agreements and tariffs. A more protectionist stance could lead to trade wars, increasing costs for companies and consumers, while a pro-free trade administration might lower trade barriers, which can benefit multinational companies in global markets. Both Kamala Harris and Donald Trump are talking tough on trade with China, but Donald Trump wants to go much further with tariffs on all goods from the country. Donald Trump has also stated he would add tariffs on goods from any country that doesn't benefit the US, which traders are concerned could mean trade wars with key trading partners, for example, with the EU over steel and aluminium imports. The issue here for traders is that this could increase the potential for a US and even a global recession. Definitely not a positive for financial markets. Number 4 is economic policies, government spending, and sector-specific impacts. The election can determine the future direction of federal spending and stimulus policies. For an example, an administration favouring more public investment in infrastructure, green energy, or technology could boost sectors related to those areas. Conversely, a more fiscally conservative government may prioritise reducing the national debt and curtailing spending, affecting sectors reliant on government contracts or subsidies. In the 2024 election, both candidates want to spend and invest, increasing the country's national debt to do so, but they are likely to prioritise different sectors. The table on screen sets out a general guide to how a Kamala Harris or Donald Trump win may impact these sectors. I should say this isn't investment advice. Harris is seen as likely to pursue a push into renewable energy with policies and incentives that are supportive of solar, wind and electric vehicle infrastructure. This could not only have an impact on the sector and specific company stocks, but could also have a direct impact on prices of copper that are a key component in renewable energy solutions. Donald Trump, meanwhile, is likely to favour traditional fossil fuels with incentives for increasing oil and gas drilling. This could benefit the traditional energy sectors, but could mean more supplies of oil and gas, which could impact prices of those key commodities. A Trump win may benefit large banks and investment companies due to his continued focus on deregulation and push towards lower taxes, while a Harris win could have the opposite effects, given her push for stronger financial regulation, greater consumer protection, and for banks to hold more capital to ensure they don't cause a systemic risk to the financial system. Looking at the technology sector at the bottom of the table, a Harris win could be a negative for big technology companies like Alphabet, Amazon, and Apple due to increased regulation and antitrust enforcement actions, which could potentially include breaking up these monopolies into smaller pieces, as well as introducing stricter data privacy laws. While a Trump win could benefit big tech with a more hands-off approach to regulation, although his more aggressive approach to dealing with China could hurt sales in a key market for these companies or even hurt their supply lines. Now, the final reason is market uncertainty and market sentiment and uncertainty. As you can see from this brief summary, there are lots of ways this election can go. The lead up to the election, as well as the outcome, can cause market volatility as traders try to anticipate which candidate will win and what the resulting policies will be. The most recent polling data I could find shows Kamala Harris leading Donald Trump by around 2% in the national poll, although this differs depending on who is compiling the data. One thing is for sure, that the race is becoming tighter as election day draws closer. So it could be sensible to be prepared for a contested or uncertain election result, at least in the week after the election. The polls are too close to call, and we know that Donald Trump contested the election result in 2020. Any uncertainty would increase volatility across all asset classes. Remember, I highlighted earlier in the webinar what's at stake: not only the presidential race, but control of Congress, the lawmaking center of Washington. Any delay in the result, a very close outcome, or even a huge shift to one side or the other could see sentiment shift dramatically in key markets, increasing volatility. And a final thing to consider as we move into November are the other non-election factors that will still be important. Number one, the macroeconomic environment. How strong is the US economy? Non-farm payrolls could tell us more about this, and that's out on November the 1st. Are the Fed going to cut interest rates 25 basis points or 50 basis points? Or maybe not even cut rates at all, depending on who wins the election. The Fed decision and press conference is out on Thursday, November the 7th. The second thing is geopolitics. What's the situation between Russia and Ukraine and Israel and Hezbollah and Iran? How is that impacting sentiment? We saw risk sentiment fall at the start of October as Iran struck Israel with missile strikes, forcing Israel to respond. These are ongoing and remain important factors influencing markets. Now, that's the end of this section. I have summarized the key points to help you steer you in the right direction. But more detailed analysis should be done into these and other key areas driving markets before trading over the election. Now, to add some more colour, let's look at the impact of the previous election on the key markets you may be considering trading. In 2016, after Donald Trump won the US presidential election, financial markets experienced a notable reaction. Contrary to some pre-election predictions of a major sell-off, US stock markets surged. The USA 30 initially fell overnight, but quickly rebounded, closing up by 257 points the day after the election. And the rally continued in the months that followed, with the S&P and the NASDAQ 100 reaching record highs. The market rally after Trump's election became known as the Trump Rally. Investors were optimistic about his proposed economic policies, such as tax cuts, deregulation, and infrastructure spending, which were expected to boost corporate profits and economic growth. The dollar strengthened significantly following Trump's election. This was driven by expectations of higher US growth, rising interest rates, and investor confidence in US assets. In the months after the election, the dollar reached multi-year highs against several major currencies. So something similar could well happen this time. In the run-up to the 2020 election between Donald Trump and Joe Biden, there was significant market volatility, largely due to uncertainty surrounding the outcome, concerns about potential election disputes, and the ongoing COVID-19 pandemic. US stock markets experienced sharp swings, with investors expressing concerns about how a contested election or delayed result might impact the economy and financial markets. This is important for this time around as well, given that this election is also expected to be very close. Now, once it became clear that Joe Biden was leading in key states and was likely to win, the stock market surged, despite the uncertainty of a final result in the immediate days after the election. The S&P 500, the USA 30 and the NASDAQ 100 all posted significant gains during the week of the election. The rally reflected optimism about reduced political uncertainty and expectations that a Biden administration would implement further stimulus measures to support the economy during the pandemic. The US dollar weakened in the months following Biden's victory, and this was partly due to expectations of increased government spending and an expanding budget deficit, along with the Fed's continued accommodative monetary policy. So that's the end of that section. Let's move on to outlining some things for you to consider if you plan on trading the event and things you could do to manage your risk during any election trading. So when approaching these unique events, giving some consideration to the creation of a trading plan can be helpful. To start with, think about whether it may help you to set yourself some objectives or goals. For example, are you looking to take advantage of short-term volatility over the election, or looking to establish trades that may take days or weeks to develop? What is your approach to risk management over the election? Are you aiming to preserve capital by minimizing potential losses while maximizing profit opportunities during the election period? Focusing on a time horizon over which you want to trade can also be beneficial. Consider whether you want to trade both pre-election and post-election, and pay particular attention to deciding if you want to be trading on election day, where volatility is likely to be at its height. Next, give some consideration to evaluating the CFDs you may want to trade. It can be beneficial to focus on what is liquid and what instruments you think are going to move and why. The US election is expected to bring volatility to the following instruments: equity indices, forex pairs, commodities, and individual stocks. So there are a lot of alternatives for you to evaluate. Just remember, if you are considering trading individual stocks, these could be prone to a much greater degree of volatility, so factor that into your thinking. Now, during the election, your research is always important, so you may want to think about preparing for various election results and assessing your confidence around what each election outcome could mean for the market you want to trade. Consider a Kamala Harris win and a Donald Trump win, and then consider those contested results. I discussed some of the potential impacts from a Kamala Harris or a Donald Trump win earlier in the webinar, but for the contested or delayed result scenario, think about anticipating extra trading volatility while uncertainty persists in the market. Think about how safe haven assets could see strong demand in the short term. Be particularly cautious with indices and individual stocks, as they may experience sharp sell-offs or reversals during those periods of uncertainty. Think about monitoring economic data releases leading up to and over the election period. And these are the jobs report that I discussed earlier, non-farm payrolls, inflation data, and Fed announcements. Do these events align with your understanding of what the election's impact on the instrument you trading could be? Keep track of those geopolitical developments that could impact trader sentiment. It could be helpful to take some time to focus on whether the market implications of the geopolitical events in the Ukraine or the Middle East may take precedence over your US election trading plan. Consider using technical analysis, and these are the price charts on the Plus500 platform. It can be helpful to identify key support and resistance levels in advance for major indices, forex pairs, and commodities, so you have some parameters to base your trading decisions on. Think about using technical indicators like moving averages, RSI, Bollinger Bands, and the MACD. These could assist you to identify opportunities to spot trends and potential key reversal points. And the other thing is consider setting up price alerts for breakouts or false breakouts at key technical levels, which are likely during highly volatile events. You can do this on your Plus500 platform by clicking on the bell icon on the right of the screen, next to the market that you wish to trade. This allows you to set a price of alert of any instrument and whether to receive it by email, text message, or push notification. Once you've set the price alert, click on the Set Alert button to confirm your selection. Now, regarding technical analysis, Richard Adcock, the technical analysis mentor at the Corellian Academy, and I only recently did a webinar on how to use technical analysis techniques in your trading. If you haven't seen it already, it is available on the Plus500 YouTube channel. Now, in terms of risk management, there are several things for you to consider focusing on. Position sizing can be crucial. Consider reducing position sizes when trading around the election to account for potential market shocks, headlines, or whipsaw moves. If you have reduced your position sizes, then this can enable you to utilize wider stop loss order parameters, which can help you to avoid getting stopped out by any election noise. Remember, you can set these stop losses on the Plus500 platform in advance to assist you when managing your downside risk. Think about using lower leverage than usual to avoid amplifying any losses during periods of extreme volatility. And think about using trailing stop losses to capture profits in fast-moving markets. The Plus500 platform offers you that functionality. Now, once you've considered your downside risk, think about your upside potential. Remember, it's always helpful to set realistic take-profit targets based on anticipated volatility and historical market reactions to the elections. If you have set wider stop loss levels to account for this extra volatility, then it's sensible to consider wider take-profit parameters to also benefit from that same volatility. You can set these take-profit orders in advance on the Plus500 platform as well to avoid missing out when you're not watching the markets. And finally, it's really important to avoid overtrading. Given the heightened volatility, it can be tempting to make multiple trades. So give careful consideration to any high probability setups you have identified and avoid trying to jump on every single move. Now, when thinking of entry and exit strategies, remember discipline is important. Think about whether you would like to create some entry triggers that are relevant to your trading plan and your trading style. Consider pre-election. Think about whether you want to enter positions based on polling trends, policy announcements, and leading economic indicators. On election day, consider if you want to focus on quick, short-term trades with tight risk management of positions, whether you would want to use technical breakouts, price action, and sentiment analysis, or whether you would want to stay out of it altogether. And then post-election, do you want to consider planning for trading when the market is stabilized, when you know the outcome, to take advantage of possible relief rallies or corrections? These are all important considerations ahead of any trading around the election that you want to do. When giving thought to any exit strategies you would like to use in potentially highly volatile markets, consider whether you want to use a combination of take profit levels, stop losses, and trailing stops to lock in gains. Remember, these are all available tools on your Plus500 platform. Make sure you are ready to adjust positions based on election-related events, policy announcements, or unexpected political outcomes. Stay flexible in case of unexpected outcomes or prolonged periods of market instability. And remember, if market conditions drastically change due to unforeseen political developments, be prepared to consider manually exiting positions immediately to avoid taking excessive risk. Now, having a trading plan and managing your risk are very important, but there are also tools you can utilize while trading around the election. Keep an eye on the polling data. Right now, it's neck and neck between Kamala Harris and Donald Trump, but keep yourself updated to determine whether there is a a shift taking place. Then consider how this is evolving over election night. What do the exit polls say? Utilize the Plus500 price charts to judge market sentiment. Are stocks at their highs again, showing trader confidence, or are they moving lower, reflecting trader uncertainty? What is the dollar doing against the other major currencies? Follow real-time election news, key political announcements, and post-election speeches, and make sure you use reliable news sources and election result trackers. I personally use Bloomberg, Reuters, and CNBC for my updates, but there are many other options. Right, that's the end of the presentation part of the webinar. Let's move on to answering any questions that you may have.